Do you like dividend income? Do you like yield? Well, you're going to love this YouTube video. Okay. We're going to talk about the best dividend ETFs that pay on a monthly basis in this video. We're going to get into this real quick. No time wasted. Let's talk about the 5 different ETFs we're going to go ahead and compare today. First, we have DIA. This is the SPDR, Dow Jones Industrial Average ETF, and guess what? It tracks the Dow Jones Industrial Average, which you might have heard of. I think it's the oldest index that there is, so got a track record. The ETF, of course, it's been around for a while, but the ETF doesn't go back to the 1800s. The index, it's a very old index, but the ETF, of course, kind of fairly new, started in 1998. The next one we have today, CDC, VictoryShares US EQ Income Enhanced Volatility WTD ETF. Then we have DGRW. I'm going to just call it DGRW. Let's stick with DGRW. Wisdom Tree US Quality Dividend Growth Fund. And then we have SPHD, Invesco's S&P 500 High Dividend Low Volatility ETF. And finally, the last one we'll talk about today, SPLV, the Invesco S&P 500 Low Volatility ETF. Who knew there were so many ETFs that we could choose from to get monthly income? Pretty interesting. So as everyone who probably watched my videos know, where are we going to start? We're going to start with the assets under management. That's a joke if you watch my videos. We're going to start with the expense ratio. So we got DIA with a 0.16% expense ratio. It's a cheap ETF considering the different ETFs we have today. Not, of course, as cheap as, let's say, a VOO, which is about 0.03%, which tracks the S&P 500 index. But, you know, this one pays monthly income, so that's good. Next up, we have CDC. We have 0.36%. We have DGRW, 0.28%. We have SPHD, 0.30%. And we have SPLV, 0.25%. So the most expensive of these ETFs today is going to be CDC, and then the least expensive is DIA. Now, let's talk about and see if CDC can justify how much money it costs for it, as almost, about 2 times more than DIA. So let's talk about this. Let's figure this out. Let's talk next, because everyone, of course, watching this, you probably care about dividend income. You probably care about yield. So let's talk about yield. We got DIA coming in with a 2.14% SEC yield, a 30-day SEC yield. If you don't know what that is, that basically just takes into consideration the past 30 days. So it's a shorter term way of looking at yields, because when you look at the distribution yield annually, it's close for this one, 2.16%. However, sometimes it can vary because interest rates are changing and the different underlying stocks that are inside these ETFs can have, let's say, drift in how much dividend yield they're going to end up paying you for a whole year. And so we might want to look, we're looking at sometimes right now, I think in this environment, it's good to look at the shorter term SEC yield. So I'm going to be kind of highlighting that one. So next up, we have CDC, 3.90 for that 30-day yield. The distribution yield for the annually is 3.47. So as you can see, big difference here between these two numbers. So, something to take into consideration. The DGRW is inverted, actually. It's got a lower 30-day with a 2.09, and it's got a 2.38 for the annual. Then we have SPHD, which is the highest yield of these, and this is a 4.94% yield, almost a 5% yield. That's pretty good. Let's say you used to not even hear those numbers, right? And now that the market's down quite a bit, now we're getting yields in up 4+%. So then we have 4.29 for the distribution yield for the annual. SPLV, 2.56%, and then 2.24% for the annual. Let's talk portfolios. Let's start with how much money these have in assets under management. $25 billion for DIA. We got CDC with $1.9 billion. We got DGRW with $6.3 billion. SPHD 3.3. SPLV 9.8. Okay, so they're all decent size ETFs. 31 holdings in DIA. We got CDC with 103 holdings. DGRW with 297 holdings. That's the most holdings out of any of these ETFs. We have SPHD with 51, and then we got SPLV with 103. In terms of the sector weightings, I don't want to go through every single sector here, but let's kind of just look at the top sector for each one. So we have 22% healthcare for DIA. CDC, we got 22 in financials. DGRW, we have 21 in IT. Interesting. SPHD, we have utilities and real estate are pretty close here, so both about 18. SPLV, we have 26% in utilities. So when we're looking at this, what I would say is, okay, the ones that are going to have more in utilities are going to be, of course, probably less likely to have more volatility, maybe. We're going to look in a second. But at the same time, they also may have a little bit lower upside potential than some of these other ones that might have a little more risk. So, of course, we have the one that I mentioned before, DGRW, Information Technology, is the highest with 21%. So, I mean, that's a pretty decent chunk to be in IT. And then actually, DIA also has quite a decent chunk in IT. Talking about the top 10 holdings, let's just go through the 3 top 10 holdings for each of these. So United Healthcare is the first in DIA, then Goldman Sachs, and then Home Depot. CDC, we have Merck, we have Bristol Myers Squibb, and we have Amgen, DGRW. We have J&J, we got Apple, we got Microsoft, SPHD, we got Altria Group, we got Kinder Morgan, we got AT&T, and then SPLV, we got Johnson & Johnson, Gilead Sciences, and Pepsi, okay? So there you go for the top 10 holdings for each of these. Let's talk about the returns because I know everyone wants to know about that. Right now we're looking at a chart comparing the returns, including dividends reinvested for these ETFs. So let's see. The best one out of all of these is going to be DGRW. And DGRW has had a 66% return over the past 5 years. Next up coming in is CDC, with a 59% return. Then we got DIA, which is the blue one here, 51%. Then we have SPLV with 42%. And then we got SPHD down here with 23%. Let's go closer here into the 1 year and then the year to date. And we'll talk about the differences when you're kind of like getting closer into the bear market here. So SPHD, as you can see, is the number 1 here in the past year. So why is that? Well, SPHD, less volatile, right? And it's, of course, been a volatile year. So you're going to get some of these ETFs, like the Dow Jones Industrial Average ETF, DIA, down the most, down 9%, 9.22% over the past year. And then if we go in, let's go in a little bit even closer here, year to date, and you can see that we got down 11% DIA. And again, SPHD is down 5%, but it's doing the best out of all of these. Just to put this into context, I do want to show you what the just general S&P 500 has done. So what I'm using for the S&P 500 is the VOO ETF from Vanguard, and what we can see here is it's right here. It's actually just below DGRW. So it's actually DGRW's outperformed the S&P 500. So very interesting. You get monthly dividend income, and you have the ability to potentially outperform the S&P 500. Of course, past performance is not indicative of future returns. Let's now go and take a look at a couple of these together and see how they look in terms of the risk. DIA, DGRW, and SPHD. And I wanted to show you how these look. So here we have the SPDR Dow Jones Industrial Average, so DIA. It has had if you had invested $100,000, what would this be worth? It'd be worth $209,000 since call it 2014, the very start of 2014. Going to the other one here, DGRW, it grew to the most, $232,000. So a decent actual annual rate of return, 10.15%. So very good. I love that. I love how this looks. We have in the Invesco S&P. So this is the SPHD with a 7.80% return. Now, this is actually interesting because I just put these in here. I thought that SPHD was going to be less volatile, but look, I mean, it's kind of crazy to me. The standard deviation is higher for SPHD, which is the one that has had the lower return over that 5-year period that we showed before, and it has the highest dividend yield, but it had a lower return than anything else. I thought it was going to have a lower standard deviation, lower risk, and it doesn't. I'm actually kind of surprised. So let's take out SPHD because it does actually have a little bit higher risk than I would have thought it was going to, even though this year it's actually held up pretty good. So let's take out SPHD for now, and let's throw in CDC, the VictoryShares ESEQ Inc. Enhanced Volatility WTD ETF. Wow, that is a handful. So we have that one now in here, and let's take a look. So we have the Dow Jones Industrial Average ETF with $190,000, $100,000 growing to $190,000. We have the Wisdom Tree DGRW at $204,000, and then we have CDC at $202,000. So these two are growing to a very similar amount of money, and then we have a CAGR, compound annual growth rate, just a little bit more for that Wisdom Tree one, but pretty similar as well. The standard deviation, honestly, Very, very, very cool. The CDC has a lower standard deviation, gets you to about the same place. So actually, that's really, really great. I really like to see that. And so if I'm talking here and I'm saying, okay, which of these do I really like the most? CDC giving you a better result with a lower standard deviation is pretty great. I mean, honestly, in my book, I like that. Now, a little bit higher expense ratio, let's say, than DIA, but let's look at one other thing. Let's say, what if we take some money out of this while this happens? What if we take out $4,000 per year? So if we took $4,000 out every year, what happens to this? So portfolio one, which is Dow Jones Industrial Average, grows 152,000. We have we have DGRW, 162,000, and then we have the CDC, 159,000. So very similar here, pretty similar compound annual growth rates, and we have lower standard deviation, of course. So CDC sounds pretty good to me. To do a little recap, the yields, the DIA, Dow Jones Industrial Average, we'll go 30-day yield, 2.14%, CDC, 3.90%, almost 4%. DGRW, 2.09%, so you're getting a lower yield. Of course, you get that monthly income, but, you're getting back to the same place. But if you really want yield, then CDC gets you back to the same place with monthly income and lower standard deviation, so a little bit less risk. I mean, it's pretty good. SPHD has done the best, held up the best past year to date. Also, best yield, but long term, the growth hasn't been as good. It's actually had more volatility than I would have expected. So I still like SPHD in terms of I think this year it's going to hold up good next year or two. However, in terms of capital appreciation, I'm not sure it's going to do the best. And then we have SPLV, 2.56, not really making it in the list, kind of in the middle there. So anyway, what do I like? Again, I think I like CDC, and CDC does have the highest expense ratio at 0.36%. So you can weigh that too. That might be a factor for you as well. That's all I got. We got a disclaimer here. Click another one of my videos on the end screen right now. See you next time.